In today's video, we're going to be discussing why most trading robots end up blowing people's accounts. And this is not because trading robots are inherently bad, but because most of them use a type of risk management system which results in exponential lot size increases and ultimately accounts being blown. And this is the term martingale, which you may have heard in and about the industry. So today, let's actually break down what does martingale actually mean. And when bots actually use a martingale system, what practically are they doing? So starting us off with the first category here, let's define martingale. And martingale is a form of bet sizing, which originated actually, I believe, in the Renaissance in France when people were playing roulette. And essentially, in a martingale strategy, if you take a loss, you double your bet size on the next bet. And this is done with the hope that essentially if you lose one bet, but in the next bet you win, the winnings from the second bet, because you're betting more money, will cover the first loss. And this is done essentially in such a way where if you keep doubling and doubling and doubling your bet size, you'll be able to recover all of the prior losses if the last bet is a winner. And logically, this makes sense if you have an unlimited bankroll. If you can keep betting and betting and betting and betting, and you never run out of money to bet, you should eventually, provided one of these bets wins, recover all of your prior losses. However, the real downside here is nobody has an unlimited bankroll, so eventually you'll simply get margin called because you go too deep into drawdown. But practically what this would look like is, let's say on the first trade you bet $1 to make, let's keep it easy, do a 1-to-1 risk reward. You bet $1 to make $1. If you lose that dollar, on the next one here we'll be betting $2. So then if you win the second trade, you would then recuperate all of your losses from the first trade plus make some profit. And depending on how exactly you're scaling the lot size here, you don't need to do a true doubling each time. Like in this case here, you wouldn't need to do that to be able to recuperate your prior losses. But the reason why this can be really dangerous is you can see it becomes very quickly an exponential series. And quite simply, if you keep doubling and doubling and doubling and doubling, it's like bacteria, and by enough runs in a row, you end up having an absolutely massive lot size. So here you can see just after a few trades, you would have gone from 1 lot to 16 lots. And just this sort of exponential growth can result in incredibly rapidly scaling lot sizes. You have to be quite careful about that. So in the context of a trading robot, how is martingale actually applied? And this is where you might hear the term grid. So grid martingale is probably the most kind of famously used catchphrase in the MQL5 marketplace. So what does a grid actually mean? And quite simply, it just refers to how positions are opened by the bot. So here, for instance, let's say our first trade is a buy. We're hoping that price goes up. However, instead of actually going up, price or the asset decides to go down. At a certain predefined distance, which is measured by a grid, you would open a second position in an increased lot size with the hope that price would eventually kind of turn around and go back into your favor. If that doesn't work again, you would then go here into a third position where you're doubling the lot size yet again, and then fourth position, so on and so forth. So the reason why it's called a grid martingale is the positions are opened in a grid form. So let's say, for instance, this is 10 pips or 20 pips or 0.1% or 0.2%. Essentially, as the position goes against you by a certain predefined distance, there is a continuous reopening of more and more positions. Why this gets dangerous is, let's say, for instance, this grid is overfit or has been developed on the euro dollar from 2022. If you enter 2025 as we are today, perhaps the volatility in the euro dollar is way higher than it was in 2022. So if this grid was developed on historical data where there's a certain distance after which it's reasonable to open a second position, if you now all of a sudden change the market environment and that distance or the volatility is quite a bit higher, you could very rapidly end up blowing an account because you could be opening too many levels too quickly. So essentially the main danger with grids is that as we're scaling the lot size at each level, if you open too many levels, ultimately you can blow your account because we're going from 1 to 2 to 4 to 8 to 16. And let's say you open 10 different levels because price just keeps going against you, going against you, going against you. You can very rapidly end up with an absolutely enormous lot size. And this is often what leads to margin calls. And this is also why it's important that if you run this kind of system, never run it on something which can have big volatility spikes. So for instance, if you try and run this on Bitcoin, or if you try and run this on gold, you can just have a massive spike in Bitcoin where Bitcoin decides to fly up by 2%. If that happens, you are going to trigger many, many, many levels simultaneously and likely end up with an enormous lot size, which significantly risks a margin call. All of why this system of combining martingale with a grid can be pretty dangerous, because martingale is a very, very rapid form of lot scaling. And if you combine that with grid, which essentially takes that and adds the potential for overfitting, because you're determining those levels based on historical data, you can end up with a recipe for disaster. And finally here, let's discuss the concept of Monte Carlo simulations. So let's say you buy your nice grid martingale bot and you start essentially playing with it. You start running back tests and you can see that, hey, like if I run a back test, like it's fine, it survives. It never actually goes to 10 levels. It never goes to 15 levels. But that's oftentimes because the grid has been overfit to meet a certain permutation of trades. So what that means is, let's say, very simple example here, we had a historical run where we had a series of 3 winners followed by 3 losers. In this particular scenario, maybe our grid never actually had to go deep into drawdown. But what happens if, just historically in the past, this order or this sequence of trades was different, and we went from 3 winners to 3 losers to loss, win, loss, win, loss, win, or loss, loss, win, win, loss, win. So obviously, over such a small series of trades, it isn't particularly interesting to look at, but what you can see is, had you taken the exact same statistics, the same win rate of the system, the same risk reward, but you just ran a bunch of different permutations, because the thing that will blow us up here is actually a sequence, and if you permute the sequences, one of them is almost guaranteed to blow up your bot. And that's what's super dangerous, because you might actually run a back test, it might look all fine and rosy, but if you actually were to just change up the order of the trades, all of a sudden, like, you could blow the account because you would have more big grids and essentially blow the account. So essentially, not only are you susceptible to overfitting, you're very oversensitive to a change in the order of the trades. And the issue is, like, there's no guarantee that just because you had a certain sequence of winners and losers in the past, that sequence will hold true going forward. Yes, your statistics might be generally the same, but you could very well have a different order of winners and losers, which is totally normal in trading due to the inherent randomness. So all of this goes to show that it's really, really dangerous to run these bots because there's so many different things that can go wrong. However, there can still absolutely be an application for grids if done properly and if they're done well, particularly if you use AI, which can significantly improve your win rates. And at the same time, it can actually be very, very practical if you are using an equity-based stop loss. So instead of you having a stop loss per trade, you can simply say, if we enter a drawdown, which is over 15%, for instance, close all our trades. So they're not all doom and gloom. You have to be really, really careful and make sure that if you use this style of bot, that you're properly protected. So guys, if you use a grid martingale, be safe. Always use some sort of protection through the equity stop loss. And please leave me a comment if you have any questions. Cheers.